Upbeat, punchy intro music fades. We're kicking off this session with a distinct bifurcated market signature. The narrative today is not uniformity, it's selection. Look at the tape, the main indices are posting modest gains, but the story is being written in the subtle rotations beneath the surface. The S&P 500, SPY, is ticking up 0.62% to 684.83. The Nasdaq, QQQ, is ahead by 0.48%, closing at 619.21. But I want you to focus immediately on the small caps. The IWM is showing superior momentum, rocketing up 1.11% to 253.58. This signals risk appetite is creeping back in, favoring the domestic, potentially more rate-sensitive parts of the market. However, the bullishness stops dead at the door of digital assets. Bitcoin, BTC-USD, is down 1.01% at $87,598, a clear retreat from recent highs. Ethereum, ETH/USD, follows suit, shedding 1.23%. This divergence between equities and crypto tells a story about liquidity preference this morning. We'll dissect that in detail. On the stock front, it's a tale of AI leadership. NVDA is powering ahead, up 1.49% at $183.69. Tesla, TSLA, is also seeing a strong bid, up 1.56% to $488.73. Contrast that with the laggards. AAPL is retreating 0.99%, and Microsoft, MSFT, is slightly in the red. The narrative is clear. Performance-driven, high beta growth is winning the intraday battle over the established mega-cap software names. When the markets are moving like this, choppy, selective, we must check the pulse of the titans who steer the ship. We have a fascinating constellation of VIP movements this morning that frame our macro thesis. First, the institutional space. Jamie Dimon's JP Morgan Chase is reportedly exploring crypto trading for institutional clients. This signals a creeping, cautious acceptance of the asset class within the legacy banking structure. If Dimon's firm is looking, others are already in the pool. Simultaneously, Elon Musk is being vindicated in Delaware, according to the Wall Street Journal. This is more than just boardroom drama. It's about governance structure and shareholder rights, a theme that resonates deeply when we look at founder control versus institutional oversight. On the policy front, Christine Lagarde's focus on the EU's AI boost underscores a global regulatory race. While she is pushing Europe forward, we see Jensen Huang of Nvidia cautioning that AI could lead to job losses if the world runs out of ideas. This is the duality of innovation, exponential gain paired with structural employment risk. We must price in both. And finally, the contrarians. Cathie Wood is buying the dip in tumbling crypto stocks to the tune of $26.1 million. She's placing a high-conviction bet on the eventual recovery narrative, contrasting sharply with the immediate bearish signals we see in BTC pricing today. Now, let's move to the bedrock of asset pricing, the fixed income market. The Treasury market is sending critical signals about inflation expectations and the cost of capital. The 10-year Treasury yield, TNX, is trading at 4.17%, posting a solid 0.43% gain overnight. This upward pressure on yield suggests that either inflation expectations are being revised higher, or the market anticipates robust economic activity that will require higher discount rates. Crucially, this rising yield is happening while the VIX, the fear gauge, VIX, is relatively muted at 14.07, barely ticking down 0.07%. We have rising long-term rates coupled with low implied volatility. This is not a picture of panic risk-off. It's a picture of repricing the long end of the curve. Remember, higher yields make future earnings streams, especially those enjoyed by high-growth, low-profit tech names, less valuable today. This structurally pressures names like AAPL, which we saw dipping, while potentially boosting cyclicals that benefit from a stronger economy, supporting the IWM outperformance. Connect those dots. The macro data released over the last 24 hours paints a conflicting, frankly messy picture for central bank clarity. We hear from Zandi that US inflation data quality is worsening, suggesting official CPI figures might be understating the true inflationary pressure. If that's true, the Fed's job just got harder. This potential inflation overshoot clashes directly with the dismal jobs data. US adds a meager 64,000 jobs, and unemployment hits a 4-year high. This is classic stagflationary texture, weak employment coupled with persistent price concerns. What does this mean for the Federal Reserve meeting next month? The calculus has changed. They are caught between fighting perceived inflation, if Zandi is right, and supporting employment, if the jobs report is right. Markets are bracing for what to expect on rates in January, and this conflict ensures the Fed's messaging will be the primary driver of market volatility until then. On the global stage, we have ECB tracking alongside the Fed, while the Bank of England and BOJ face unique domestic battles. Ursula von der Leyen is pledging solidarity with Greenland amidst renewed US interest, a geopolitical move that hints at strategic resource competition, which, down the line, impacts commodity supply chains and inflation. This macro conflict, high yields, shaky labor, possible underlying inflation, suggests central banks will remain data-dependent, which in the current environment, means unpredictable. Let's turn to the physical economy, commodities. Gold, GC=F, is shining brightly, up 1.62% to $4,516.70. Gold thrives on two things: geopolitical uncertainty and, critically, a loss of confidence in fiat currency strength. Its surge strongly supports the notion that the market is hedging against the domestic economic contradictions we just discussed, the shaky jobs report and the underlying inflation fears. Oil, CL=F, however, remains subdued, dipping 0.12% to $57.94. Crude trading flat suggests that while financial uncertainty is high, physical demand expectations are not soaring. This is partially reflected in the Trump campaign's move impacting the Venezuela trade route, adding a layer of geopolitical premium to oil while the underlying demand picture stabilizes. The currency market shows the dollar index, DX, softening by 0.28% to 98.01, and the EUR/USD strengthening to 1.18, plus 0.66%. A weaker dollar generally supports commodity prices and makes foreign assets more attractive to US buyers, which could be a subtle tailwind for SPY today. The sector action is highly granular. The winner, the clear standout, is the technology sector, driven by the AI narrative. NVDA, plus 1.49%, and TSLA, plus 1.56%, are leading the charge. This momentum is also evident in the general sentiment favoring stocks in buy zones, like Palanta and GE, as noted in general headlines. The focus is on high beta momentum plays executing on secular trends. The loser, technology hardware, services, specifically the giants like Apple, AAPL-0.99%, and Microsoft, MSFT-0.21%, are showing relative weakness. This rotation suggests investors are moving from established platforms to pure-play growth accelerators. Furthermore, the rise in the 10-year yield acts as a gravitational pull on these long-duration stocks. We also see news referencing Google launching Gemini 3 Flash, indicating the AI wars are escalating rapidly. The key question for traders: are you betting on the infrastructure providers like NVDA, or the application layer like Google? The intraday tape slightly favors the former today. We must address the underperformance here. BTC-USD is down 1.01%, ETH/USD down 1.23%. This is significant because, typically, risk-off environments hit equities first. Here, the digital assets are leading the retreat. This could be interpreted as a sign of tightening liquidity preferences, or simply profit-taking following parabolic moves. We see the Ming of the Soros camp. George Soros is being politically targeted by the BJP over his alleged interference, which highlights the ongoing political scrutiny surrounding global capital flows. More pertinent to trading, We see Michael Saylor expanding dollar reserves rather than Bitcoin holdings, a tactical move that echoes current market hesitation toward extreme crypto concentration. However, Cathie Wood remains aggressively positioned, buying $26.1 million of tumbling crypto stock. She views the volatility as a buying opportunity. This polarization, Saylor trimming, Wood buying, shows institutional consensus has not been reached on the immediate path forward for digital assets. For now, the short-term tape suggests caution prevails over conviction. The environment dictates a tactical, nimble approach. 1. Watch the IWM. Its 1.11% rise is the best indicator of current market sentiment. If small caps continue to lead, expect rotation out of the mega-cap tech stalwarts and into domestic cyclical value. 2. Yield trajectory. Pay close attention to the carat TNX. If it breaks significantly higher, the gravitational pull on high-valuation stocks will intensify, and gold's rally may be sustained or accelerate as a hedge against both inflation and currency debasement. 3. AI specifics. The performance gap between NVDA and AAPL must be monitored. This divergence defines the leadership structure of the overall market rally. We are in a phase of internal market stress. The major indices look stable, SPY up 0.62%, but this stability is an accounting illusion masking significant structural adjustments underneath. We have rising bond yields contradicting cooling jobs data, while gold screams for inflation protection. The market is being forced to digest conflicting signals regarding growth, labor health, and monetary policy. The institutional players are hedging. Dimon is exploring crypto compliance, while Buffett is having a tough spell. The mandate for today, investors, is vigilance. Don't trade the headline index number, trade the rotation. Focus on the names demonstrating superior internal pricing power, particularly where innovation meets profitability. Outro music swells.